Hello, ladies and gentlemen, and welcome back. In today's show, we've got a big one. We're going to be talking about following the central bank liquidity. This is going to be a big story, I think, in 2023 into 24. And at the moment, let's just say financial conditions aren't tightening like Jerome Powell from the Fed has to say. FOMC meeting minutes, Nvidia earnings call, and a whole bunch of AI stuff. We'll be talking about stocks, commodities, and cryptos, and all the key levels for that S&P 500. See you soon. Well, welcome back, everybody, to the Daily Show. We've got the big macro coming up, both the long-term and short-term kind of concepts, I believe, that are the biggest right now. We'll have also got, of course, the lead indicators and the key levels that you should be looking at on the hottest charts. Let's bring in Nvidia, though, because they had their after-hours announcement and their earnings call. I mean, I couldn't see anybody mentioning AI more times. I posted on this over on Twitter. Follow at FX Evolution if you're interested. But basically, the markets were up. And they were actually within the tolerance of what the options market expected. That between 6 and 8% was what they expected. It was actually up on that after hours. We've now gotten back close to extreme zones. So we're going to need to really watch this one. And we've got some detailed reporting on Nvidia a little bit later on. What about the FOMC meeting minutes? Well, there probably wasn't that much discovered within these meeting minutes. Markets kind of went up and down and all around during it. But almost all the participants agreed in that meeting minutes that they were going to raise rates 25 basis points. I guess what's surprising and probably would have freaked the market out if they didn't already know this would be a few of the participants were now going towards 50 basis points. So remember, Goldman Sachs have come out and said 75 basis points of more hikes. This is becoming the new concept of the markets. And if it does happen, it probably will lead to equities going down a little bit. What I found most interesting, and I posted this on Twitter, was inflation was mentioned almost 91 times, rates was mentioned 24 times, and recession was only mentioned 4 times. So clearly at the moment, no one's thinking about recession. So I want to get into some of the biggest concepts and some of the things that I think we all should be watching in markets. And one of them has to be this: liquidity of the central banks, the G6 liquidity feed from basically the Fed, the ECB, the Bank of England, Bank of Japan, Bank of Canada, and of course China. Now, what we know is that supposedly there's tight conditions, but they are not as tight as they were late last year. Since that spike, we've seen markets recover, and I believe this is a huge part of the situation. So we're needing to follow the central bank liquidity feeds. We'll be doing that on the channel, and we'll be doing that throughout, I believe, 2023 into 24. They eventually disconnect partially, but at this stage, this is one to definitely look at. People's bank liquidity injections in the world business climate. You can see again, China, as we mentioned in the previous video, are injecting because they've got a sick economy. It's projected to get even bigger. And at some point, this usually does lead to higher asset prices. Specifically for Chinese stocks, this is going to be the central bank policy for quite some time. They've got a big problem in the property market, and they're looking at fixing it. The rest of the world, however, they should theoretically be tightening conditions, especially off the back of the most recent news. So we'll have to see if that actually starts to come through into these markets. So what do we know? Well, let's look at some of the facts of history, I guess, and then talk about whether this is possible or probable. Well, bear markets have always bottomed after the start of recessions. Now, we're not in a recession right now, basically, according to at least the markets and what everybody's believing. The bonds market, however, tells us that we are very likely to go into one. So does this mean that we have a potential of rallies still into dumps later on this year, or whenever a recession is called? I think the facts are very likely. What's most important, though, is that when you get a recession to start, when the official recession is here, generally markets will have already bottomed, or they're about to bottom straight on that call. Now, recessions don't tend to happen when everyone believes they're about to happen. As you can see, during these kind of previous times, when the net percentage was saying a recession was likely, it was already there. Whereas right now, November 22, as of this announcement, we're starting to see a decline of that. And that's good. If you're somebody that believes that recessions are coming in the US, then you want this to go down. You want it not to realistically be the discussion point and then kind of pop its ugly head out maybe later on this year. There are some key factors that we tend to see appearing with that, but just remember that the Fed most likely has broken something. When they raise rates at the speed of which what they've done, and they taper those rates, which they will do at some point this year, when they actually start to cut, it most likely will mean a recession is happening, and it also should mean that the stocks will fall. So basically, we usually see the taper, the cuts, the recession come after, and stocks drastically fall before that. Just keep that in mind because at some point this will occur. We also know that what economic kind of indicators can warn of a recession. Well, first up, inverted yield curves. 2-year versus 10-year. Don't forget about it. The bonds market's probably smarter than you or I, and they've definitely predicted that a recession is coming. 50% of plus of all yield curves are now currently inverted. I think it's like 60 or 70%. They're early, very early, on average 16 months early. Now, I did some numbers, and it looks like we're in about month 11 to 12 at the moment from the first really big inversions. So we're getting closer to that point, though I could state that I think it could be like 18 months from inverted yield curve to when we see it. Unemployment is going to be the one that I'm watching the most. We need to see it rising from the cycle trough. Now, if you've been following markets recently, you would know that the US posted some big jobs numbers, and realistically, we're not seeing unemployment rising. We're actually seeing it still drop. So what does this mean? Well, there's so many other factors we can bring in here, but I just want to talk more about this medium term, because stocks also tend to fall when EPS growth turns negative. Now, at the moment, we're still on sugar rush, and that's showing up in the economy. And I've got a reason why I believe it's happening, especially in the retail crowd world. And I think it's going to cause a problem later on. See what you think if you agree. But EPS has now almost turned negative. Now, this means that the next earnings announcements, the next ones in the future, and maybe it's the one after that, will be the most important this year. Because once we start to see this EPS really turning negative, it will put massive down pressure, especially on growth stocks. So what is the market thinking? Well, our opinion could be like, oh, it's all good. But the market is definitely not thinking a recession. In fact, it's not even pricing it in. If you look at this chart here, you can see no recession versus recession is a huge difference. So the current rate is basically following no recession. And if we do not get a recession, the trend has historically been, yes, pullbacks, but overall bullish. So if you're a bull in the markets right now, let's face it, you're going to be very, very happy if recession never gets called, because at this stage, the trajectory, especially in pre-election years, tends to be very, very positive. And at the moment, it's starting off like a typical pre-election year. Very positive, great things, probably coming into a seasonal weakness period that we'll talk about soon on the short term. But overall, yeah, that's what it's showing on these charts. We also know that when we get these Fed pivots, which eventually will come this year, we tend to be up or bullish into the Fed pivots, which guess what? We are right now. And then when we see the pivot, markets start to turn off. Now, this is only when we have inverted yields, which we have massive inverted yields right now, some of the biggest on record. So effectively, we've got massively inverted yields. We know the Fed will eventually pivot. We just don't know when. And that we know that when they do pivot with inverted yields, the history is not good for that. So some of these things, again, it's all about timing. It's all about understanding when you want to hold things, when you don't want to hold things, and more your top-down view. What are you going to do? Are you going to invest? You're not going to invest? You have to make these decisions and allocate these risks. So do we know that this is a weakness time for markets? Well, on the short term, let's talk about the short term right now. We know that the middle of February tends to bring the bears, and that can drive over to March. In fact, it generally drives into March into around the 10th to the 20th of March. So this may make sense to some options, because we'll look at the options chain a little bit later. The puts are pretty big this week, which is holding these markets at these current levels, and we actually think there might be a jump here. But overall, there's still this potential to actually get a second deeper dive by the middle of March, and we'll discuss that. Now, why are markets going so hot? Well, I think everyone became accustomed to buying stuff. I mean, the US consumers have been on a shopping spree for a long time now, and you can see that after COVID, everyone bought some extreme amounts. Now, it's because of stimulus, but the stimulus is technically gone. So how are people doing this? Well, it has to be US credit card debt. I mean, you see here, US credit card balances are near $1 trillion. So at higher interest rates, more people are going to have to pay this back. We've got higher interest rates on new loans, in property. Obviously, in America, there's a lot of fixed term loans. So that's not going to affect people as much as we expect. But overall, higher interest rates, people aren't aware of this yet. When they start having to repay it, they're going to go, oh, wait a second. What did I do? What did I buy? Better sell that on Craigslist or Facebook Marketplace or whatever, because you need to get some money to pay back those expensive credit card debts. And this just is the proof. This is the data that's coming out right now. Now, we also know that Q1 and Q3 tend to be the most volatile times. At the moment, we're kicking it off right when we expect to kick it off. Middle of February into middle of March tends to be that kind of weakness or scary period. And then you actually get a lull that then comes into Q3. Now, remember, could Q3 actually be where more likely a recession could actually start to rear its ugly head? Well, I think we want to be looking a lot at the job numbers, and this is going to be a big one moving forward. We need to see actual real weakness in the jobs numbers, because until we see that, we can't use that as an economic indicator to say, well, actually, maybe we're possibly 6 months off from being called a recession, and start to look for the signs of this weakness. You know, timing is everything, and this is a big one. We've also got a chart here that I think is pretty interesting, and this comes from, I believe, Spot Gamma. And basically, it's a good, I think, intersection kind of thought process with markets. Having a look at the idea of low IV of the options market. So that is when we have really low IV, implied vol, basically low VIXs as well, and then the peaks of the markets. Now, you'll notice that we just reached recently, before this drop off, the low IV. So when we have these low IV periods, you need to get a little bit of juice started in the markets, and that allows those kind of markets to drop and then potentially even rally back on. So it all kind of happening at the right time. We've got the seasonality of that February into March period. On the short term, we obviously have a huge amount of stimulus coming back into markets, which is why we can explain really the last kind of month and a half. And at the same time, we know that eventually the American consumer is going to feel the pain, unfortunately, of these higher rates. So it's kind of working into timing's everything, and we've got to look at these charts and think about it logically. Let's move over to whether Wall Street's even moving into defensives at the moment. Well, it wasn't really a day of defensives. In fact, before the close, we saw metals, we saw discretionary, so this is spending in itself, and we saw some of the kind of more tech stocks looking like they were the better ones performing on the session. If we take the last 5 days into account, we do see a little bit of moves into staples and utilities and healthcare, and we do know that these tend to have better periods over this next Feb to March zone. Will staples actually show us that it's going to hold? What I'm looking for is, if we rally here in markets, I want to see staples, utilities, and healthcare rallying nicely with the rest of the market. And that will show us that there's a bit of rotation from Wall Street and the composite man going into those. If you're looking at earnings, then of course, here are the big earnings coming out. Most of the big ones are already over this week, but we do still have some coming. And remember, Etsy did pretty well, Nvidia did pretty well, and Teladoc, as per usual, didn't do very well. Lots of write-offs there. So make sure to know this. I love this chart because it gives you the implied movements, and it's all sitting there very easy. And of course, something good to look at. So just before we jump into the charts, I want to say a big thank you to the sponsor of today's video, which is Tiger Brokers. So in recent years, people have really enjoyed the idea of auto investing or dollar cost averaging. This is something that Tiger Brokers have added into their platform, whether you want to select high dividend yield or even followed the great Warren Buffett and his stock picks. You can do things such as this inside of the Tiger Brokers platform. If you want a specific stock, let's say Apple in this case, you can literally select an amount, choose a frequency, whether it's every payday, every day, or every month, or even 2 weeks. And then it's as simple as pressing OK. From that point, you just need to put in your password and then it'll be set up. Voila, all done. So if you're interested in Tiger Brokers, it's as simple as literally just clicking the links down below and looking at some of the special offers. If you fund with as little as 1 cent, especially from Australia, I've added an additional Microsoft fractional share for you at the moment. You guys know I like the Microsoft. So you get all of this stuff, plus you get the features. Why not check them out? So without further ado, let's get into the VIX and let's get into these charts. And I think we'll start off here with the volatility. Volatility spiked into the FOMC meeting minutes. However, it did come back off. I don't think the VIX is giving us too many good readings at the moment, but it's up and you expect that over this period of time. Remember, it's seasonally up at this period of time as well. US 2-year yield held its own against the FOMC meeting minutes, which is kind of important. And we didn't really see too much difference or change on the longer term. We're up now to 5.36 is what the bonds market, not our opinion, the bonds market expects the federal terminal rate will get to. Some people are now posting in 6%. If that does happen, markets should fall off further. So that's going to be something that we want to be looking at. Let's move over to treasuries. Treasuries have come down to some nice levels. They're not exactly at super levels, but they're down to some nice zones. Now, treasuries are going to suffer a lot if interest rates go up. Just remember that. If interest rates keep going up, treasuries will suffer. If you believe we're getting close to the terminal rate, treasuries could be the thing that you're looking at. I do believe that whenever you've looked at bonds in the past, usually people hate them. At the end of cycles, they tend to do really well. People also tend to need them if they believe a recession's about to occur, because that's when you tend to see the biggest uptick in bonds. And that's when usually the portfolio managers come out and say, okay, we see the recession. In recent months, recession concerns have become drastically lowered. So this is something to keep in mind. If everyone starts talking about the recession again, I wouldn't be surprised at all to see treasuries do a little bit better. Let's talk about high yields. High yields saw a spike up. We're looking for rejections here. If the stock market is recovering and high yields are down, be concerned. Start thinking about markets obviously turning over or tipping over. And in your technical analysis, we're looking for, of course, those shorting kind of scenarios. But at the moment, we've kind of seen them lockstep at this stage. But high yields, junk bonds, a place to be very scared of. Dollar index hit our highs, so that was really nice. We saw dollar index basically tap off onto the highs. A nice strong close for the DXY as well. It's not at our critical zones yet, which of course up here in the green box. But I wouldn't be surprised to see some weakness for the DXY and then ideally some strength. And this may coincide with the stock market and some of the thoughts that we have a little bit later on. But we're still looking for DXY to strengthen into that kind of 105.25 zone or higher. Still bullish, still trapping people. At the moment, DXY is doing a good job. Gold, I'm going to remain neutral on this. I know that gold doesn't like high yields, but at the moment, it's kind of just holding its little demand zone. I'd like to see it back down in the 1790, 1800 level. The current trend is theoretically down. We'll find out what it does, but yeah, gold's kind of sitting pretty at that zone. Copper rejected the key critical level that we looked at. I'm looking for weakness in copper in March. Maybe we'll do a special on it, but at this stage, of course, China liquidity has definitely boosted the copper through the Friday. We put that in the last video. We talked about the China liquidity. It was pretty massive. This is a critical zone for copper. We need to see it continuously fail here. And March tends to be a pretty bad time. So we'll find out whether copper can actually hold and short off. Natural gas had, I believe, a contract flip. So basically we saw it, a rollover, and it kind of bounced off its lows into the new one. Now, I need to really reiterate this. Natural gas is a trade that a lot of people are looking at right now, but it moves like 10% a day. So you've got to be very, very careful. It's called the Widowmaker for a reason. It is generally a futures contract and rolls can be brutalized. So just remember, if you haven't traded these types of things before, be very, very careful in these markets. At the moment, all I'm looking for is a weekly close. I'm very interested to see how the weekly closes. We haven't necessarily based yet, but I would say this plus the roll will have trapped quite a few people into bad positions. And at this point, we're looking for closures above the 260. Remember, forming a base after such a hectic drop is not easy, and it does take some time. We did see US oil also drop off pretty drastically. I'm looking for closes underneath 73, which we've held for a long time in terms of thought process. And at this point, well, they're not there yet. But I've got an alert down here at 73, kind of 10. We'll see whether that can be broken. Let's move over to Tesla. So markets rejoined or rejoiced in the retail kind of stocks specifically. We've got Nvidia after hours doing really well. Tesla's got a lot of latent demand into it until it actually gets busted down. And if markets recover, you've got to think that Tesla, Nvidia, some of these others will be the ones that are driven. Basically, retail is running the show at the moment and Wall Street's letting that happen. Whenever there's a big flurry like this, whenever we see drops, these ones tend to have that kind of like initial pickup, but they're more traders than anything else because you've got to be really careful at these price ranges. We're not in our extreme level number 2. We're kind of in the middle of nowhere land. We saw the trend line, the small trend line on the 2 hour, get broken down below by Tesla. But realistically, this is going to be driven a lot by the SPY. What is the S&P 500 allowing itself to do? And although I believe Tesla will get back down to these 140 lows, at this stage, we haven't seen enough signs to push us there yet. We'll keep reporting on that. What about the options crowd? Well, it's all about 210, 220, and a ton of calls up above, and 190 remains that kind of put for the week ahead. So 210 might be a tough point for Tesla to get through. I would probably think that the markets, based on what we're seeing in the options, would kind of hold up to 210 by the end of the week. But we'll find out whether that does occur. And of course, that's the options chain. Now, we know Nvidia came out with earnings. It was a pretty good one in terms of the market. When you say AI that many times, you do well. And that's how these guys are doing it. I'm telling you, like, if you're a CEO right now, you just mentioned the hottest topic, you just keep saying positive things. I almost don't know why anyone listens to earnings calls sometimes, because they're not going to say anything negative generally. They're all positive, all AI. So the word AI pushed us back up to around 225 in after hours. The way it reacts to this level up here is going to be super critical still. So, watch around that 230 to 227. How does Nvidia react to that? That's going to be a big deal. And I wouldn't be surprised that it may struggle to kind of close above here, but it may also move into the gap. So I wouldn't be surprised to see like that. And we'll find out whether it does occur. So Nvidia is very dangerous at the moment, but certainly one to be watching. I was playing with some concepts about IWM as well versus the S&P 500. Generally, you see the Russell start to really heavily recover versus the SPY in times where you're kind of looking for that kind of growth curve in America. You're not really seeing that at the moment. It's I would say, lackluster in terms of the recent move in January, but that's where we've got it. Australian market still looking towards weakness here. I think seasonally it's coming into a bit of weakness. We've also got that kind of Feb into March period of time. And the problem with the Australian market is it's very heavily stacked towards materials and energy and some of the things that are getting hurt at the moment. So US oil obviously down. We've also got metals like copper. We're looking at potential weakness here. So the Australian market may suffer for some time. 7,100 and 7,000 key critical levels to look at on the charts for all the Australians out there. Chinese stocks continue to weaken. Contrary to popular belief, you would think, wow, well, they should be going up in all this stimulus. Well, for now, they already bought the rumor on the stimulus. Now they're selling the fact. I still think there'll be a pretty interesting opportunity here on China stocks. Are you willing to take the geopolitical risk? That's, of course, up to you. Qs versus SPY, big level, huge zone, huge ratio. Have it on your chart. Not much to mention today, but chuck it there. It's going to be a big one. What about the triple Qs themselves? They're still trading at the weekly options low. I think the after hours, especially Nvidia option or the Nvidia earnings call with so many AI mentions, that really got the markets kind of revved up. And there's a lot of gaps. See all the gaps that have been left behind? There's some stuff that we could be filling here on these markets. Dow broke through. However, it's come back down to, of course, a key level of demand. So we're back basically at a support level for these markets. And in terms of the US 100, we've seen that nice after hours bounce. But I want to talk about SPX. So it's a doji of sorts. We've got a low, we have a high, we have an open and a close. Now it followed on from a bearish candle from that close wick. So it's not a surprise that we end up getting another red candle. But what we now can do is we can now say, okay, well, we know where our high was from the previous session. If we breach through 4017, then that's kind of like a positive sign towards filling some of these gaps. And boy, oh boy, do we have a lot of gaps around 4080, 4090. This is going to be a critical level. And I'll stack this just for you in a few seconds to show you how critical it really is. If we go over here to the SPY, we know we're at the weekly options expected lows, which kind of helps the idea of bulls retesting it and looking at that. Notice also this candle here around those gaps. So, again, a nice little test level for the markets. And if we move to the US 500, I've put in a 61.8 fib as well, which now with high swing to the low swing sits directly on the unfilled gaps themselves. So I wouldn't be surprised at all to see markets find some recovery. They were really sneaky and would have taken quite a lot of stop losses near the close. They've fallen under this low, which kind of now signifies a potential switch of trend towards shorts on the short term, which is pretty strong because, of course, if this occurs, then that really plays into that March narrative, which is weakness into strength, maybe pushing us into the 3800s again, where we've got absolute kahuna kind of levels of demand that could come through in these markets. And remember, there's so many options as well to expire, so many puts sitting in these systems. So we'll look at those in a second. But yeah, nice looking potential recovery. Traps were set straight after the meeting minutes, basically, or up and then back down. Closes down here, really sneaking out a whole bunch of stop losses, maybe hunting those. And now we're seeing a little bit of recovery. But if we get past, some of these alerts, such as 4020, I could see markets recovering and possibly starting to push to that narrative of 4080, 4090 gap fills. Wouldn't be surprised at all to see markets back up there. Let's now refresh here because this is the options for the week. Why are we even going on about 400 and anything to do with, this idea that 400, 395 might be purchased? Well, it's got to do a lot with the amount of puts sitting there. We've got an unusually large amount of puts sitting on 400 and also 395. So in here, it's probably in the market's best interest theoretically to hold it above that level this week. But let's go through the March period. So if we go over here to March and we go to 3rd of March, yeah, we've got puts, but they're not anywhere really massive. And we have a lot down at 370. So again, the puts aren't huge here in the next week. Then we move over to, I think it's the 10th. And the 10th, again, the puts seem to be lined up with prices that are pretty unrealistic, 340s, 330s, 350s. These are left over from last year, no doubt. And we've got equal amount of calls and puts on the 410 and 385s. Again, 385, a critical zone, 380, 385. So it enables that potential seasonal to play out here. And then, of course, we've got the March 17th, which is 390, 400. So all of a sudden it goes back up to being, well, wait a second. So what if you had a market that did this? It kind of plays well with what you've seen in the past. So very interesting times. The biggest issue for bears has to be the amount of puts. I mean, it doesn't matter which month you're looking out to, and basically until May, it's very difficult for markets to get through some of these levels. Now, it's not saying it's impossible. It's just that we've seen this time and time again where there's so many puts out there, and unless there's a huge shock to the world, they may not want to pay them out, because a lot of them are retail traders. Bitcoin's being supported, no doubt, by the stimulus in China. This is basically a China play at the moment. I think if we do breach out of this 25,000, because we're seeing stocks finding some bid here, if stocks continue to find bids and we end up breaching past this and closing, more importantly, I wouldn't be surprised at all to see Bitcoin potentially a little bit more bullish than you think, like maybe upwards in that stupid $30,000 range. So it would basically blast through. This really is a stimulus play. So at the moment, Bitcoin, we're correct on thinking that 25,189 is a super critical level. Bears are still safe for now. The reaction around here will be important, but I do feel like there's a lot of heat coming back in on this, and a lot of people are talking about the China stim. And realistically, it is having a positive impact for now. So we'll have to find out whether it can hold up. But just be warned, could be some wild action on the crypto markets. It doesn't really change my long-term opinion of it. But at the moment, yeah, we've got some interesting stuff. Let's move over to the news for the week ahead. And it's really pretty simple. We only have a few bits of information coming out now. We have the prelim GDP. I'm not sure if that should move the markets much. Usually it doesn't, but we'll see. And then we've got core PCE price index coming out 8:30 a.m. Friday 24th. Thanks so much for watching today, guys. If you enjoyed the video, then check out our links in the description down below. Follow us, get 3 free trading cheat sheets as well if you're interested, and sign up for our newsletter through doing that. We will be putting out a whole bunch of data coming forward if you're interested in that type of stuff. And remember, check out the sponsor of today's video, which is Tiger Brokers, and see some of the special features. I've been focusing on giving you guys a bit of a look at some of the features they do have. So why not check them out? And hey, if you fund with as little as 1 cent from some countries, you can get a whole bunch of bonuses as well. It's basically free. All right, catch you for now. Bye.